Welcome to the Riskwiser Zone, the show where we dive into the world of stocks and finance to help you make informed decisions about your investments. We're starting off with a look at the current state of the Indian stock market, where experts are weighing in on the potential for growth in 2026. According to recent reports, the market is expected to remain positive, driven by strong earnings growth and a favorable economic environment. However, some analysts are sounding a note of caution, warning that certain sectors may be overheated and due for a correction. Sandeep Nayak, a seasoned expert in the field, recently shared his insights on the market, highlighting the importance of rigorous stock selection and a focus on companies with clear earnings visibility. He also noted that foreign institutional investors are showing renewed interest in Indian equities, driven by growing valuation comfort and restored confidence in the country's long-term growth trajectory. Meanwhile, the Nifty is trading at around 20 times forward earnings, which is in line with India's long-term historical average. However, some experts are warning that this premium may not be sustainable, particularly if global liquidity conditions tighten or if corporate earnings fail to meet expectations. As we navigate these complex market dynamics, it's essential to stay informed and adapt to changing circumstances. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into two fascinating stories that highlight the intricacies of investment decisions and market dynamics. First, let's examine the case of Navan, a company that has seen its stock plunge 60% from its 25 IPO price. Despite this significant drop, Singapore-based Napean Trading and Investment has disclosed a new stake in Navan, acquiring 5,874,257 shares in an estimated 100.33 million trade. This move represents 19.52% of the fund's reportable AUM, signaling considerable conviction in Navan's potential. Navan provides an AI-powered software platform for travel, payments, and expense management, leveraging artificial intelligence to deliver an integrated solution for corporate travel and expense management. The company has reported 29% year-over-year revenue growth, with gross booking volume up 40% and non-GAAP operating margin expanding to 13%. However, GAAP losses remain steep due to stock-based compensation and debt-related charges. On the other hand, we have Navan's counterpart in terms of investment interest. Sasan Goodarzi's portfolio also includes a significant stake in Robinhood, which carries more weight than Navan. This indicates that the investor is leaning hard into fintech-enabled platforms with transaction volume upside. For long-term investors, the question remains whether Navan can convert its 40% booking growth into durable margin expansion. In contrast, another intriguing story revolves around Sasan Goodarzi's portfolio, which has a significant stake in Navan and Robinhood. The $100 million investment in Navan accounts for approximately 20% of the portfolio, demonstrating a substantial commitment to the company's potential. Meanwhile, Navan's stock performance since its IPO raises questions about the market's perception of its value. Moving on to our second story, we explore the case of Navan's peer, where Napean Trading and Investment has taken a different approach. The fund has established a new position in another company, allocating roughly $100 million to the stake. This investment strategy highlights the diverse approaches investors take when evaluating growth potential and risk. As we navigate these complex investment landscapes, it's essential to consider multiple perspectives and evaluate the underlying factors driving these decisions. Whether it's Navan or other companies, understanding the intricacies of their business models, market trends, and investor sentiment is crucial for making informed decisions. Welcome back to the Riskwiser Zone. As we wrap up today's episode, I'd like to bring to your attention a fascinating story about the intricate world of international trade and energy markets. It appears that California, the most populous state in the U.S., is facing a unique challenge in meeting its gasoline demands due to refinery outages and retirements. To bridge this gap, Gulf Coast refiners have found a creative workaround by shipping gasoline to California via the Bahamas. This detour allows them to avoid using expensive U.S.-flagged vessels, which are required by the Jones Act for shipments between U.S. ports. Instead, they're opting for cheaper foreign-flagged tankers, which can transport the fuel from the Gulf Coast to the Bahamas and then on to California. This trade route has become a significant component of California's troubled supply chain, with the state sourcing more barrels of gasoline from the Bahamas last year than it had in the prior 9 years combined. While this workaround may provide some relief for California's energy needs, it also raises questions about the long-term sustainability and environmental implications of such practices. As global energy markets continue to evolve, it's essential to consider the complex interplay between trade policies, logistics, and environmental concerns. It's also worth noting that other regions, such as Asia, are becoming increasingly important sources of gasoline for California, with countries like Japan, India, and South Korea supplying more product to the state. As freight costs continue to fluctuate, it will be interesting to see how these trade dynamics shift in the coming months. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.